All right, welcome everyone. So today we would be going deeper in our discussion around the institutional order flow. We would be looking at, just a minute, let me try and mute out some people. We'll be looking at how to use institutional price levels in conjunction with order blocks and FIB levels to pick trades, high probability trades from the market. And after then, we'll look at a review of what happened in the markets last week, or rather this week. The week just ended, and see how we could learn from that and prepare for the week ahead. The last webinar we had, we tried to hint that this month rather, is going to have a lot of volatility because so many central banks will be making interest rate decisions, and we all know that these contributes to volatility in the market, right? So for traders who know what they're doing, it could be an avenue to catch some pips from the market. And if you're a newbie, it could just mess things up for you. So hopefully at the end of today's webinar, you would have added knowledge to whatever you have before. Again, we'll have Darren Flynn taking us today on institutional price levels, order blocks, in conjunction with FIBs. Darren Flynn, thank you. Are you ready now?
I am ready, Bishop.
All right.
So I can jump straight in.
Yeah, over to you, bro.
Okay, so as we know that, well, you may or may not know if you've watched the previous videos, there are certain price levels that are very important when you trade. And these price levels are not the retail levels that we are all accustomed to. They are specific levels on any chart that you potentially find. So these price levels are basically the mid figure and basically they call it the 800, the 500, the 200, and then you could call it the round number. There's other names for these numbers, but these are essentially the institutional price levels. Now, if you've ever added these levels to your chart, you will see interaction at these levels. So basically, all I'm going to quickly show you is if I now go and add the institutional price levels, this is GCAD. So if I go and add the institutional price levels of this pair, we can see how price intersects at these levels. So to start off here, we will start with the 200 at the top here, because we can see that this was the first institutional price level that price rejected off at the top of here. Then at the bottom, if we put our price over here, we can see that price now intersects with this 500 level at the bottom over here. And you can see that when relatively strong bounces occur, these bounces or rejections will generally happen around these institutional price levels. So you can see what I'm doing here is all I'm doing is adding these levels, and you can see how price is interacting at these levels. So I'm actually not looking on the side over here on the right hand side. I'm just looking where you would see rejection or support, as retail would call it. And you can see how price is intersecting at these levels. So there's nothing fancy about doing this. It's very straightforward. Anyone can do it on your phone even. It's a very straightforward indicator. You could call it an indicator. But essentially, the importance of this is that you have to think about it from a perspective of when we come into the market, what actually are we trading? Yeah, sure, we're trading a pair, and yeah, sure, we're buying or we're selling. But of that pair or commodity or the price, the oil or the stock, we are looking on the right-hand side over here. And essentially, what is it we're looking at? Well, it's just price. Price is here. On the right-hand side here, on any pair is price. So price is important to us because of the fact that everything we do, we transact in prices. So pips is just price. So essentially, that is why these institutional levels are so important. And anyone can add them to their chart just to see how price interacts. Oh, sorry, I made a mistake here on this one. This is supposed to be the 200. And we can just add the rest of these over here. And you can go ahead and add these to your phone as well, and you can see how price will intersect. It is important to know these levels because you may or may not know that price is not random. It is a byproduct of the algorithm that runs. So I'm not sure if we've ever covered that, but basically price reacts on these levels. So let's just look here. I've put in my chart over here all of the institutional levels. Let me just add the remaining levels of this particular pair. If I've missed any here, 500, 200, 800. So here is our round number in price. And 800, 500, 200, and our round number in price, 800, 500. Okay, so essentially I've done just adding price lines of where price is currently trading. So let's just take a look here. And now I'm going to apply my Fibonacci retracement tool. And we all know what fibs we use. We've put it in the group of what the settings are. If you don't know what they are, you can just look on the group. But essentially, all you need to do is pull your fibs basically where price either rejects from or rallies from. So here is my Fibonacci. So price rallied from this area over here. So this is the 68,500 price level. And where did it rally to? So we saw this rally come up here. It rallied up and price stopped over here. Price, you can see, stopped over here, which is the round figure of 1.7, and then it retraced back down. Where did it retrace back down into? Well, you can see over here that this is the 62% retracement right over there like that. And you can see price is consistently tagging these areas because price, you can see if I move my fibs now, MetaTrader. So their price again rejects at this level, which is the 200 institutional level. And where does price reject from? 62% again. Again, this is our institutional level. Price rejects. Where does it go to? Our OTE level. And it's important to know that although I've only added a fibs here, you can add other confirmations as well. So at these institutional price levels, we also can see that order blocks are present, obviously. So this is a 4-hour chart, and you can apply this to pretty much any pair, and you will see the interaction. So again, price rallied to this level here. So this is the 71, 200 level. So let's pull our fibs because price rejected from this level and rallied to this level over here. We can see down here. So I pull my fibs down to here, and you can see now price is interacting at this level. So what I will do is pull my fibs to the round number because that is where price is interacting at. And you can see when price rallied up, it went past the equilibrium. But if you were patient, you would have got a perfect OTE entry over there on that position. Now, this is a 4-hour chart. So basically, I'm just going to go down now to, let's say, the 30-minute. And we can see the same occurring here. So if you've watched the previous video, we apply the fibs from the source to the candle that creates the breaker, you will know that I also showed you the 15-minute chart and how to pull a FIBs. So you can see here that if I take my FIBs here, and from this level over here, price rallied from, and where did it rally to? It rallied from the 800 level into our 500 level. So we pull our FIBs from the 800 level to our 500 level over here. And you can see that this would not have been an entry because price had rallied and rejected off there. Now, sure, we don't get an entry there, but if we move our FIBs up, so price then was consolidating between our 200 level over here. So this is our 200 level, and this is our 500 level. So when price rallied again, it rallied from our 500 level over here. So what do? We put our FIBs on the 500 level, our starting point, because we're pulling a bullish FIBs in this scenario. And where did price rally to? It rallied to the 500 level of this price. So we pull our FIBs to the top. Now you can see when price retraced, we got a 62 bounce over here. Okay. And you can see now price is basically trading from our 7,500 level to our 69,800 institutional levels. So you can see that price is now between from that zone, this zone. So what do? We've already pulled our FIBs from where it broke out from, so the 69,500, and we can see we got a 62 bounce over here. So now we know that price is trading inside the 500 and our 800 level. So we pull our FIBs to the level that we are trading in, and we've already broken the market structure over here. So this over here was our market structure when price was consolidating in, and when it broke out, now we've taken these highs. So now we are basically looking for a continuation of price. Okay, so, and we know that from the ICT that this is also a breaker, and we know that breakers like to be tested. So it is not the BTM breaker block, but it is the ICT version of a breaker. But regardless of that, that is where market structure broke. Price braked out over here and traded in this zone over here. So that is why we pull a bullish FIBs from our 69,800 level to our 7,500 level. And you can see price then would have given us an OTE entry over here. So here would have been our OTE entry. This is also a 30-minute chart. So if you were to take a trade here, your pips value is lower than it is on a higher time frame. So essentially you would want to use, say, whatever your trading plan considers. I like to use 30, as I've said before. Sorry? Okay.
No, go ahead, Darren. I think somebody does a mistake.
Okay, so price rallied from our OTE level here. And if we had used, let's say, 30 pips, we would not have been stopped out over here. And we would have caught a nice trade going up to the top here. And you can see over here that when price rallied from our 800 level, it then rallied again. This wicked us. So we potentially, if we were still in the trade and we didn't take profit at the top over here, when we got to our institutional level of 7,800, we would have been stopped out. But that would have been a bad trading plan, because if we look here, I mean, we're already in 60 plus pips profit. So you at least should have moved or taken some of the profits, at least break even, worst case. So that kind of trade shouldn't have hit your stop loss or anything. But essentially what I'm doing is I'm just showing you how to use the institutional price levels as an additional confirmation. Now, you know how much I like my confirmations, and the institutional price levels can be used for multiple purposes. So this is one purpose that I've just showed you now, where price interacts at certain levels and then it breaks and either trades inside these levels, or you can pull a FIBs, or you can use the levels as a form of, let's say, price rallying or price rejection or target levels. So we know that we can also use liquidity voids or fair value gaps as target levels. But if you're not familiar with those terms, it doesn't really matter too much because we have these institutional price levels. So when price rallied up here, it rallied into our 800 level. And if we were to take now another trade and we said that let's look for a bearish setup. So we pull our FIBs down to where price rallied to. Okay, so price rallied down from our 800 level into our 200 level over here. Notice we didn't get an entry, but if we were patient, we would have got an OTE fill over here and price maintained our sweet spot between our 79 and our 62. Now, if you take and say an OTE trade, that is very minimal stop loss you would have or drawdown you would have been in for the trade, and you would have been in 50, 40 plus pips of profit. So this is, you can do this basically on any pair. Let's take a look at, I know a lot of people like to trade EU. So let's just do a quick EU here. And let's just look at current market price. So I'm going to again just add my institutional price levels over here, and we can see that price rejected at this 800 level over here. And again, we just add in our 500 level, which is the next level down. And let's add in our 200 level over here. There is our 200 level. And again, our round number over here. Okay, so now let's just add in one more over here. Would have been our 800 level. Okay, so there's our 800 level, which is where price is currently trading at right now. But you would see that when price was at the 12800 institutional level here, it basically broke straight up. And where did it stop at and hesitate at? Which is basically our 13500 institutional level over here. So this is now where price is trading in this zone over here. So our 500 level over here. And now, because we know that we've followed our institutional order flow and it's still bullish on the higher time frame, we can look for another buy. And so how would we look for another buy here? Well, let's take our FIBs now. So we know that price is currently now trading at our 200 and our 500 institutional level. So all we need to do is pull our FIBs from our 200 institutional price level over here back into our 500. Because why? Because price rallied into the 500 level, rejected that level, and now it's basically accumulating orders in this zone. So we want to look for bullish scenarios, and this is how we would look for a bullish scenario using our FIBs and using our institutional price levels. Notice how we would have been filled over here, and I mean that's really minimum drawdown and a really tight stop loss if you had taken a trade using your FIBs over here. And let's just see if we can do this in reverse. So that would have been our bullish scenario. And if we had ridden the wave up from this area into here, well, there's another 50 pips straight for you over there. Okay, so this is a 1 hour chart, and these institutional price levels can be applied to any chart. So let's just take a look at the 15-minute chart over here, and I'm going to again use my FIBs over here. So when price came into this 800 level and rejected over here, price then started to fall. Okay, now we know on the 15-minute chart over here that this black candle over here we could have used as our, say, breaker, our order block that turned
last step
negative. Exactly, last bullish order block before the down move. So when price rejected at this 800 level over here, we know that there will be hesitation at this level, and we pull our fibs in a bearish scenario over here. And when price rallied down, it did not touch the 500 level, but we still use our 800 to our 500 because price is currently still trading in that zone. And when price bounced off of our 500 level, we wouldn't have been filled in this scenario, but I'm showing you how it is possible to get entries like this. So again, we just do the same now here. So when price came to our 500 level and broke down into our 200 level, we just pull our fibs down like this. So there now is our 500. Let's just make this completely accurate over here. So that is our 500 level over there. And you can see when price rallied down from our 500 into our 200, we would have been filled perfectly over here in our order. Okay, so you can repeat these steps over and over again, but basically all you need to keep in mind with these kinds of setups is the institutional price levels and where price is currently trading at, and the zone that the algorithm is working, because banks don't trade and institutions don't trade all the time. They have to obviously sleep, and then other banks and institutions take over. That is how the sessions work. And we all know that, like, the Asian session is an accumulation stage. So the best scenarios would be during the working day for the London Open and the New York Open. So you wouldn't find these kinds of setups in the Asian range, because that's just a whole bunch of accumulation for the next day to capture orders from the retail traders. So what we can actually do here is, here is another setup. So we know that, let's just add some more price levels over here at the bottom. So this would be our round number over here. So I'm just going to work this whole zone so you all can get accustomed to what I'm showing you and how we can do it. And then we can take some questions, because you would have to practice this on your own charts to get accustomed to it. It's not something you're just going to get immediately. So here would be our 500 level, and 200, 500, and our round number we've got. Okay, so what are we doing here? We can take it also now. Let's go down to our 30-minute chart over here. So here is market structure again over here. So over here is market structure. And when price breaks out of this market structure over here, so where did price break this market structure from? This is the institutional level that price broke the market structure from. So instead of using bodies or candles or wicks, we're using the institutional price level here. So where did we rally to? So we rallied from the 500 all the way up into our 13,800 level. And you can see that if you were entered here, you possibly would have maybe just wanted to close the trade on the weekend, but the same scenario here would have applied, that here is where we rallied from on the higher time frame to our point on the 800. So let me just show you this on the 1 hour. The same would apply. So again, here is our market structure, and the market structure price level break was at the 12500 level. And where did it rally all the way to the top? Our 13,800 level over here. So the reason why I'm showing you the importance of institutional price levels, we've discussed this before, I think on the group and on videos, that broker price and actual price is not the same. So whether you use FBS, IC markets, XM, XNES, whatever, hot Forex, whatever broker you use, your high and my high and your high candlestick and my high candlestick will not look the same. Our order blocks will not look identical. There will be some similarities in the chart, how it looks, but there won't be the exact same data displayed. And that is because each broker has a liquidity provider where they get their liquidity from, and your broker and my broker have different liquidity brokers, and that is why there is also broker spread. So broker spread also creates different candlestick formations, and the reason why we're using the institutional price levels is because of the fact that that is more accurate source of data than going on what we are doing using just our broker price, because everyone's broker price may be different and the candle will look different. So that is why institutional price levels are the same whether you look at your chart or you look at my chart. You can go and practice this. If you've got two brokers, you should definitely go and look at two charts and compare them. Put your institutional price levels on both and see how price reacts. So let's just have a look here. Price, you can see the price is rejecting at our 800 level. So when price comes to our 800, we see some rejection. These are price action levels. There's nothing more to show you. This is it. This is the price levels. You just need to add, as I said, the 800 level, the 500 level, the 200 level, and your round number. So that is just the 1,700, the 1,600, or whatever price or currency pair you are looking at. That is why the price of the institutional price levels are so important. And it would be the same when, so here is a markup I previously did of AU. So this is a 4-hour chart, and you can see that starting from around this bottom level over here, you can see that my order flow, I've started some of it here, and you can see that the order flow is basically intersecting at these institutional price levels, and you can see how price is trading inside these institutional price levels while also creating order blocks for us because we are following the institutional order flow. This is a 4-hour chart. And again, price rallied up. It broke through our 800 level over here. There was a bit of hesitation over here at the 500 level, but then the next 4-hour candle created another order block for us here. Where did it create it? At the 500 level. Price then rallied up, and you can see where did it rally up to? Into our round number over here. So we've discussed this before in previous videos, but I don't think everyone has come to the party and seen how relevant the data of an institutional price level really is. You can see there again, here's our 6,800 level, and here I'm going to just put our 500 level. You can see how price action occurs at these levels. Here is another order block. So you can see again, our 6,800 level, nice order block created, another order block inside an order block, but we know we don't mark those up just to make our chart a bit neater. But you can see price reacting on these institutional price levels. And again, we just add our institutional price level here of 200. And you can see again, price reacting, trading inside of our institutional price levels over here like this. It's very easy concept to understand. You basically just applying it as an additional confirmation to see how price action is occurring. There's nothing more to show you here, and I think once you all go and add these to your charts as a confirmation, you'll see and realize how important these levels are. So all I'm doing is just adding them, as you can see, and here our top one was our round number. This is AU, and there was some price rejection over here. Price hasn't closed above our round number at the top over here. And again, there's another order block created over here, basically on our 500, 200 institutional price levels. So again, if we go now, say, to the 15-minute chart over here, and we go to recent price data over here. So let's just look for a bottom over here. And essentially what we are doing is when price rallies up, so where does it rally up from? Our 6,800 round number over here, and price rallies into our 68,500. You can see price is trading within our level over here, and price rallies and breaks our 800 level, rallies up, a little bit of hesitation here at our 200 level, and then rallies into our 800, our next 800 level over here. Where does price rally down from? It rallies down from our level over here into our 200 level, okay? When price rallies down, it continues to rally down. It doesn't, you can see it trading here in between our 500 level and our 200 level. And when price breaks that, we are still trading at the top here because this is where price fell from. And you can see it fell to our 500 level over here. Here's our 500 level, and there's our previous 800 level. So you can see again, there was a little bit of drawdown over here. If you had taken the OTE, so 15 pip drawdown, and you would have got a nice trade over here to take you in of about 60 pips. And it's good to go and practice this. We can't sit here all night looking at all the examples. It's really straightforward. You just add your institutional price levels of these numbers here. I'm going to just leave it a moment here on the screen so you can see 800, 500, 200, and the round number. And then you just go and basically do what I've showed you here on the video with your fibs. And that's it.
All right, let's check if there are questions in the chat box so we could attend to them before. Someone is asking, how do I plot institutional price level? I guess you've attended to that already.
Yes. So yeah, again, we can see here on GU that if we look at the 4-hour chart, so when price rallied up over here, there was actually an order block over here. This was an order block, and price actually closed above, and this would have been our source over here. So that would have been our source candle for GU during this week. So we know that we need to be patient, and just because we have a break over here doesn't mean that, you know, automatically we're going to be selling. So if we had sold over here, this is also actually a bearish order block, even though it took 2 candles to create this bearish order block. We can see if we put our institutional price level over here, so let's just put our 200 price level over here, and you can see that not only, let's just zoom in here. So you can see over here that this is actually a fair value gap, an institutional price level, and an order block. And again, there's another order block over here. So that's another order block over there, and it bounced off there. And I was in this trade for the bar. I'm just mentioning this because I know a lot of people like to trade GU as well. And this might have fooled someone because they maybe wanted to sell when they saw this rejection and close inside of our source on the 4-hour. It's not a bad trade. If you had taken the trade, maybe you would have at least broken even over there. But it's important to see that the interaction over here, not only with our institutional order flow, but with the institutional price levels. So look at that, 24,800. Let's add another one. 25,500. And we can see price rallies up. Where does it rally into? Right over here, which is our 800 price level. So you can see that there is reaction, and here is our round number. So you can see when price came to our round number, there was rejection, but then price eventually closed above. Where did it close above? 200 institutional price level. Nicholas, so you would draw your fibs from the level around where market structure was broken and not from the beginning of the move. So I'm showing you this because of the fact that institutional price levels are the same whether you have whatever broker you have and whatever broker I have. So if you are pulling it from the candle bodies or the candle wicks, you will get different data representation based on the fact that your broker, your spread is different, your candlesticks are different. The institutional price levels are the same regardless of the broker. So that is why I show you the institutional price levels.
All right. Victor was telling us that he has I think it was Victor, yes. Yeah, Victor said I have an MT4 indicator for this. Good, please share with us on SimplyPips.
Yeah, I will send it.
All right, great. Who else again? Can this be done? Can this be done in a consolidating market? Well, you know, for now, we trade basically institutional order flow. And institutional order flow is a trend following strategy. And if you monitor, let's say, between 2 to 5 pairs, and you notice a particular pair is consolidating, you simply leave it out, except you have another strategy that could help you trade consolidation effectively. Institutional order flow is basically a trend following strategy. But I don't know if Darren Flynn or Prof has something to say as regards using these on the consolidating market.
Well, it depends what they determine as a consolidating market, you know, because say on a 4 hour it could be consolidating, but on a 15-minute it could be ranging, you know.
Right.
So
like EN did that like for the last 2 months, say for last week or past 2 weeks, it's been ranging on the 4 hours, and 15 minutes or 1 hour down to 15 minutes was more or less like a trend. So yes, I think I agree with that.
okay, so here's another, just a quick example. So we can see that on Euro USD, I do Euro USD again because a lot of people like to trade it. So when price rallied into here, this 200 level, it rallied into our 500 level over here. But then it rallied past, and you can see it's important, even though that this is a 1 hour chart, it did not allow, the algorithm did not allow price to go to the 800 level. So it's important to note that you would pull your fibs down from the area that was protected, okay, because this 800 level was protected and it rallied from our 200 level, okay. So if you look here, you can see that price rallied, even though it rallied from here. So you can catch the big move on a higher time frame. But when price is trading in a zone like this, you want to include the wicks as well. We're not putting the fibs on the wicks, we're putting it on the institutional price levels. So when price rallied from our 200 level and price was rejected, we say it was rejected over here at our 800 level because it broke through, it wicked. So the price, the algorithm protected this area and rallied down. It rallied up, and where did it rally into? OTE. So you'd have to practice this. You're not going to get it like instantly, but I can show you guys some more examples later on, but you'd have to practice this. And I think what I've showed you is enough to equip everyone on how to do it. It might be a bit difficult on your phone. I've actually never personally used fibs on a phone, so I can't say.
Yeah, all right. So let's see, Nicholas. So you will draw your fibs from the level around where market structure was broken and not from the beginning of the move. You're looking at it in between the institutional levels, right? Darren, can you find Nicholas' question? Do you understand what he was trying to ask there?
Who, Andy?
No, Nicholas in the chat box.
On Euro USD, why did I draw from 1 to 500 and not 1 to a round number? Because this is the institutional price level that broke market structure. So although there is an order block over here on this 1 hour time frame, and you can see price rallied up and hesitated over here, but this is essentially the level that broke this market structure, because you can see here was an order block and here was an order block. So this is essentially where the move was created, not this move, because price rallied up, hesitated, and then rallied up. Does that answer your question, Nicholas?
Yeah, Afolabi is asking what institutional levels. I think you might need to watch the video again. He explained 800, 500, 200. Yeah, okay, fine. They're on the screen. Then, yes, this looks similar to Ian Itavo, something like that. Something there is somebody, is it Ilan Itavo or Ivato, something like that, has a book, The Quarters Theory. And this looks similar to the Quarters Theory. The Quarters Theory uses round numbers, 100 pips basically. So if you're moving from like 1.12 then to 1.13 will be the quarter points, that the main numbers. Then you have the quarter points in between, which will be 50, 50, and 25, 25 pips. If you've been following us on SimplyPips, there's a template I use that has a blue black background. Okay, maybe when I'm doing the weekly the outlook for last week, I'll show you that. So yes, it looks similar to the quarter points, but institutional levels, for me, I don't know who actually started it, but made popular by Michael of ICT. The institutional level being explained here is the one that Michael explains that the interbank algorithm works with, right? I think that's the name, Prof. Is that the name? Interbank price delivery algorithm, something like that.
I think so. It's called like delivery action or something like that.
Yeah.
Interbank price
delivery system.
Yeah. IBDA. So yeah. So enterprise delivery algorithm, something like that. So yes, Nathan is asking the question: wish to know how and where to catch price in a trend after missing it. So far threshold is in order block is what I know. Okay, so far threshold in order block is what I know. But the confidence is sometimes a problem. If you hear that price will give a breaker rather than continuing the trend, I believe this presentation will give more. Did you catch that, Prof, or Darren Flynn? Did you catch what Nathan was asking?
Nathan, do you have a pair that we can have this as an example? I can see if I can show you.
But I think you mentioned something. Guys, if you have a strategy you're trading with, don't be in a hurry to discard whatever you're trading with for every new revelation. Else you'll never grow. You'll just be a beginner for every strategy. And I tell you, almost every week or every 2 weeks, you would find something new in the market, something that wows you. If you throw away everything you've known simply because you saw something new, then you always be starting again every 2 weeks, right? So even the institutional order flow, we've given how to enter using LSB, which is what I use. We've given entering LSB together with TDI, where you look out for shark fins and divergence. We've also given us how to just go in once you have a break of LSB without a retest. You just go in, and we had somebody, Caleb, teach us that. We also have Darren Flynn mentioning FIBs. And I want you to know that the way he draws the FIBs here is slightly different from what we had the last webinar, where we're drawing it from the wicks of the candle on the higher time frames, and now the body of the candles on the 15 minutes time frame. Now, all of these are just opportunities to pick pips from the market, but you have to go back test one or two, then, you know, sit down on just one or two so you don't get yourself confused, right? So what Nathan is saying is that if you miss a move, the way we trade it in institutional order flow is that once you miss a move, you wait for price to trade back into the order block, either into the threshold of the order block or the like, if you want to use pending orders for you to take the trade. Now, what other way can you use to catch a trade should you miss the initial move? And what we're discussing today is one of them. So you might need to go through this video again and see. In Euro USD example, did not get clearly where the trade should be taken. Directly might need to explain Euro USD again, but for John, so I look at price bounce, then I round the price figure to institutional price level. Yes, something like that. Now the idea is this. The idea is that price is not random, and that price is actually aiming at doing something. Aside taking liquidity, price will aim at rounding up its the banks will aim at rounding up their activities at certain price levels, which we call institutional price levels. Right now, one of the challenges we had initially when we're going through institutional order flow is that we have 5 people with 5 different brokers, and in some brokers we'll have something that looks like an order block because we'll have a bearish engulfing candle, and when in some other brokers the candle color will basically be the same, so you wouldn't really have a breakup per se or an order block in this case, right? So what we're saying is that if you use institutional price levels, irrespective of how long the wicks are or how distorted the candle body is, institutional price levels are institutional price levels. They would remain the same irrespective of the broker. Now, if I'm a broker that is a grade A broker and my spread is wider simply because I have insurance for my customers' funds and less slippage and everything, of course, that's why I'm a grade 1. If price moves for 5 pips during a volatile market, the wick on my own brokerage account will not capture 5 pips. It might capture 7 or 8 pips. Now, if you go to a less a broker or maybe a grade C broker, it might just capture 6 pips because adding 1 pip to that volatile movement in the market. Now, if we draw our FIBs based on the wicks of the different brokers, we might have different levels. So we're trying to introduce institutional level. Just use the institutional level it will be the same irrespective of the broker.
Bishop,
yeah, go ahead.
So here is what I spoke about previously, where we took the fibs from the source to the candle that created the breaker. So in that video, I explained that if you go down to the 15-minute chart, you can use the bodies of the candle to the bodies of the candle. Now here, this is Euro USD. So if we take it, the fibs from the bodies of the top over here, where this move happened, and where price rallied from, so this is from the body to the body, and price rallied up, we would have got a 62 bounce on that area. Now let's just incorporate, before we move into any more pulling our fibs down, let's just add our institutional price levels here so that people can understand what is actually happening. So before I added the institutional price levels, I've already pulled my fibs from the body to the body, okay? So now you'll see that if I pull my fibs, let's just delete that. Instead of pulling it from the body, now I'm going to pull it from the institutional price level. And you can see I would have maybe seen some reaction, but not have entered depending on how everyone trades, if they trade with limits or execution. But we would have got a 62, just missing our 62 bounce over there if we use the institutional price levels. Now again, so I'm going to pull my fibs from the top of this leg that broke the market structure. So here is our market structure over here. So this is what I showed you in the previous video. And now I'm just showing you the importance of institutional price levels. So here, price not only, this is a 500 institutional level, but that is also an order block. So we can see the move downward. So I'm going to pull my price from the top of the body to where the price bounced from. Okay, so before we even look at the institutional level, I'm using the bodies, and we would have got a rally up into our OTE and ride the wave down. Now I'm just going to add where price rallied into. Where did it rally into? Institutional price level. So what I'm showing you exactly is you may not see these bodies occurring on your broker, but we are trading institutional price levels. That is what essentially I'm showing you, and the importance of them. And you can see there, I haven't taken this trade. I'm just showing you how one would do it. So again, we follow it, and let's just do it again. So if I delete, okay, well, there's no point deleting the institutional price levels now because they're already there. So price rallied from here into this zone over here. That is our bottom, okay? And we can say that the bottom over here is our institutional price level that it rallied from, because although price didn't touch it or close near it for this bounce, it still protected. The algorithm protected this zone over here. So although price did not touch it, it protected that zone and rejected up. And you can see we came into our price level over here. Now, if I pull where price essentially came from, you can see that it is less accurate, but essentially what I'm showing you is where price is rallying from. Oh, sorry, I didn't pull this down to where it rallied to, and you would have got a 62 bounce actually. So if I pulled it, because that is where price rallied from and rallied to, and we were bounced up, 62 full, and there you go. Any questions?
Nathan, the question you are asking will take us 72 years to explain. We should understand quarter points, hesitation, flip zone, mitigation.
I personally don't know. I've heard of quarter points, but I don't trade them. But you say it's similar to the institutional price levels.
Yeah.
I only know the institutional price levels because of ICT content.
ICT.
I don't know from any other things.
All right. So I guess we're done with questions. Thank you.
I think flip zone also is a BTM concept.
Yeah.
I think I've seen that.
Nathan, I've told you before. See, you need to calm down. Seriously, you need to calm down. You can't. When you are starting, you should give yourself time to grow. Trying to get all those things at once and begin to apply all of them in your trading will simply, like Bishop explained earlier, will just confuse yourself. So if you're going to use quarters, because if you're using quarters theory, for instance, you're going to be looking at the 250 levels, you're going to be looking at the 50 levels, you're going to be looking at the 750 levels, and then the round numbers. Now, how do you combine that with using ICT institutional level, where you're supposed to be looking at the 20 numbers, the 200 numbers, the 500 numbers, the 800, and then the round numbers? So you just have a situation where you have a lot of conflicting ideas about the way you trade. So you just have to watch out for that. Go and practice. Take one thing, practice it, ensure you master it. Then you can begin to add other tools to your toolbox. I hope that helps.
Yeah, thanks.
Yeah, so again here, look at this. This is EJ, and this is actually a trade I personally took. So price rallied up. Now, we know that when there's hesitation like this, there's potential retail traders trying to sell, and I've obviously followed the bullish orders, institutional order flow, and price rallied up. It hesitated at our round number of 120,200 and rallied down into our order block over here, respected our 500 institutional level, our 200 institutional level, and rallied up. And I took 100 pips on that trade and rallied. I took profit basically at the 500 institutional level, which I think was my 100 pips over here. Yeah. So that is the kind of confirmation, not only the institutional order flow, order blocks, and there was also a 1 hour order block inside that zone over there that price bounced off of.
Great. All right, so let's quickly do see what happened last week. So Darren Flynn, let's put a 555 in the chat box as we appreciate free knowledge, and it's going to be on YouTube, guys. So you can always come back and watch. And like Prof said, you have to give yourself time to grow. You have to give yourself time to absorb this and give yourself time to grow. You can't do it.
You missed one question overnight.
Yeah, someone has a question.
Please, where do you start drawing the RPL from? Well, Borby, Akpe. Basically, you can use it in the price that, so let's just pick a random pair over here. So all you need to do, let's just look at AJ over here. It's pretty simple, really. All you need to do is look where price is currently ranged from. So it's ranged from this level over here and ranged in this zone over here. And basically, you just draw your institutional price levels in the zone it's trading at. Otherwise, then your chart's just going to be messy. So just draw it where price is relevant.
So I think that answers the question. Okay. All right, so I'll share my screen now. We just do 1 or 2 more things and call it a wrap for today. Thank you so much for that free information. Free information, basically. Right, so yeah, so let's see USDX. This is DXY, the dollar index for last week. It was basically bearish. And for those of us who understand the institutional order flow, you notice that once it broke this zone, right, once it was bullish as at 2 weeks ago or thereabout, Control Y here. Yeah, so once it broke this zone, it was basically bearish, right? So this was the other block responsible for that low, and price respected it. This other block respected by price. This other block respected by price. You notice how price kept dropping, right? And what we try to do in institutional order flow is, or rather what I hope you would want to do is stop trying to catch these reversals. Go with the flow. When these reversals are happening, if you are in more than one Telegram group, well, maybe not more than one, more than 2, 3, 4, 5 Telegram groups, you get confused. Now, because this little move here, you see things like target smashed, target destroyed, target filled, so many funny things. And you feel, you feel like you're missing out on something, that something is just not right with me. Can you compare this short rally, this short correction, in fact, is a correction, to the massive drop that happened, right? Just look at the green candles. Look at the width of the green candles, all put together compared to the downward move. Now, with institutional order flow, we would miss some trades. For instance, 2 weeks ago, I was basically bullish the dollar, and I was hoping that the dollar will actually take out these highs here right, before giving any form of bearish move. And it did move a little, didn't even fill up the fair value gap up there before changing direction. Of course, that meant that I might have missed one or two trades or even had an outright loss on some trades. But the move, this downward move, has more than compensated for whatever loss. So I see people trying to catch every move in the market and trying not to lose any trade. It's not possible. We just need to understand. Someone asked a question in SimplyPips that institutional order flow, is it a 90% or 99% strategy? And he got an answer. There is nothing like 99%. In fact, there is no assurance in trading. What you have is high probability trades and low probability trades. Institutional order flow gives you high probability trades, and in spite of the fact that we say high probability, the fact that the word probability is there means that there are times you could take a loss, right? So if you see that played out nicely on pairs like EU, right? If you understand your currency strength, that played out well on pairs like EU. EU basically rallied all through, and if you're in some Telegram groups, they were trying to sell EU forcefully, and it just kept buying and kept buying and kept buying. The institutional order flow states that you should expect price to continue to buy until it stops buying. Until it stops buying. If you understand ICT better, then maybe you could go to the daily time frame, go to the weekly time frame, and now look for order blocks where you expect price to reject. I think something like that happened last week. It was Nathan that asked, and we basically drew out this order block on the daily. This color is too bright. Let's find something. We basically drew out this on the daily last week, and we anticipated a drop, and we actually got a drop, right? Notice that week there, that was the rejection of the order block, rejected and pierced through. Presently, we are in this order block here, right? And price seems to be respecting it. But until, the way I trade, until I see a breaker on the H4, I'm still bullish the Euro USD. Now, so the advice is first master how to follow the trend. Then when you've done that to a relative level, you are now consistently profitable trading the trend, then you can now create time to catch the counter move, right? The counter move. So the example Darren was given for a sell here, of course, if you go down to the lower time frame and you understand how we use the LSB, you clearly see that the last step was broken here, right? So this was the last order block responsible for this high, and price came and broke it here. Showed even better on the 30 minutes or even the 15 minutes. You could see it, price broke it, and usually we would mark up. This is a doji, and this doji simply means in some brokers you might not find this candle, right? So institutional price level might solve that problem now, but this might be the level we'll be considering. Price broke it, and what we'll do is we'll take the retest and sell. But when you're selling against the institutional order flow, you basically want to break even and take your profits as soon as possible. Yes, you might catch the move earlier. EU could basically just drop off the sky the whole of June. Nobody knows. But the fact is that you're going against the trend right now. You want to take the profit as soon as possible and move, right? So we saw that in EU. Let's go back and see how EU played out, right? That was the order block, price respecting the order blocks. If you don't understand what we mean by order blocks, you might need to go watch the previous videos. Price respecting the order block like clockwork. I love the way it reacted here, like clockwork, right? Respecting it and rallying, right? Very sweet when it plays out. Very sweet when it plays out. Something similar happened with, I think it was GA. GA played out something I had to close GA late Friday because I wasn't willing to hold on to a trade for too long. But GA, this was the other block here, right? And price basically came into that level and dropped. EA did something even sweeter. Where's EA now? Yeah, here you are. Right now, if you understand how to trade the counter trend, you could have caught this move. Right now, some persons thought that EA was fully bullish. Well, you might be right. It might come up next week and then rally all the way up. But using the institutional order flow, we have another block here. And when price traded into this order block, I took my short trade, right? And I had to close it on Friday because I didn't want to hold beyond. So just follow the trend. Stop trying to guess what price will do next, except you have a magic wand or you've understood price action so far. I understand that many of us in SimplyPips are just trying to come up, trying to put one or two together. So let's not mix up so many things together. Pick as little as you can. Stay focused on it until it begins to, I say this and I say it, I'll say it again, until you start withdrawing from your trading activities. You are not a trader. You are just playing with your mobile phone or your MT4. Until you are able to go to the bank to withdraw proceeds from your trading activities, you are not a trader. Right? You're just playing with your MT4. And you need to grow up. You need to grow up beyond playing with your MT4 to start making money out of the market. It's $6.6 trillion free money for, well, not free, but money you could actually pick for free after you've gotten the knowledge. What other pair would I want to look at? EN, CEN. Several persons were buying EN from this point. They were buying EN from this point. EN, as far as we're concerned, had not broken this step. Yes, is a massive 310 pips if it actually rallies. Agreed, massive one. But EN, EN was bullish as at last week. It was bullish as at last week here, right? But it dropped off from this zone here and continued its move. I was actually anticipating that when EN returns to this zone, it was going to rally, right? But once it broke this zone downwards, I was bearish. Right? You trade what the market gives you, not right the whole of the day on 15 minutes. And finally, when they are tired and bored, they just pick a direction. They just pick any direction and then sit down to pray that price will move in that direction. That is not trading. It's the oldest trading style in Forex. It's called the hope and pray strategy. And unfortunately, it hasn't worked for so many people.
On the 4-hour Bishop, if you look, it tested the breaker as well on EN.
Okay, on EN?
That wick there tested the breaker.
Oh, you mean this, right?
This wick here.
Oh, yeah. Tested the breaker on 4 hour. I get you now. It tested the breaker and then now dropped. So guys, free value for all. Prof, yes, I promised I was going to say something about this. We've been using this template for those of us who've been following us for a while. In this template, you will notice some points here. This is the quarter points, 8.87500, which is an institutional level, right? Then we have this other one, which is 88250, is called a hesitation point. Then we'll have this, which is a half point, 88750, right? And this is 250, and it continues like that until you get a round number. That's the round number there, 0.900. But you notice that the round numbers are the institutional levels. So they come in thick lines, and the other ones are either dotted or dashed lines, right? So as not to, model up things, just pick the institutional levels like we've been taught today, and we'll wait to see what Victor has. He said he has an indicator. If he actually has an indicator and it works, fine. Else, it's very easy to just plot your institutional levels yourself by dropping a line, double clicking on it if you are not used to MT4, right click on horizontal line properties and look for the closest figure close to where price is. I think we've done enough for today so that this will not be too long. I thought we'll have the time to look at what happened during the week, but I think we've done one or two. That should be enough. So again, I'm going to plead with us. While we trade this week, mark up your charts. You could drop them in SimplyPips. We don't want to make SimplyPips a place where people come to show their profits, right? I'm not saying don't show your profits, but if you show your profits, show us the chart and let us know why you took the trade. You might not be bold enough to let us know why you want to take the trade before you take the trade, understandably. But let us know why you took the trade after you took it. We will still manage that because that way we can learn. And it's not that somebody made $200 today and is flashing it off our face. We don't really appreciate that. I don't think we have another question. Prof, anything for us as we round up?
Practice, practice, practice. Everything you learn is useless until you use it. Go practice.
Thank you so much. Darren Flynn, parting words?
Protect your capital, stay in profit, and be disciplined.
Yeah, so the next joint Zoom we'll be having, we'll be looking at confluence of confirmations, right? Should I just pick a trade simply because price has retraced back to the OTE? Are there other things I want to see before taking a trade? If you trade IOF the traditional way, we have certain confirmations. Want to see LSB, want to see shark fin, want to see all of that. The next time we come online, maybe this time next week, we'll be looking at confluence of confirmations. We might have a bucket list of about 9 or 10, and you just pick whichever 4 or 3 or 5 you want to see happen before you pick a trade. What that does is that it reduces the number of trades you get to take and increases the chance of the trade going in your favor, right? So it is not the number of trades. There are times I take just 4 trades the whole week, but you still meet your target, which is what matters. It's not the number of trades. So thank you guys for coming online today, and I hope we've been able to add something to your trading career. Hopefully one of these days we'll all buy skyscrapers somewhere in the moon.
Trade and get paid.
Yeah.
All right, thanks guys, have a nice day.
Thank you.